It all began with a nice game of poker that ended in total disaster. In 1983, Wells Fargo executive Bill Biggerstaff and Stanford University professor Robert Medeiros were enjoying a game of poker when they came up with an idea to create a bank that focused on serving the needs of startup companies. Little did they know that this friendly game of cards would eventually lead to the rise and fall of one of the most iconic banks in Silicon Valley. They hired Roger Smith, an expert in high-tech lending, as the bank's first CEO and president, and lined up 100 investors, including NFL quarterback Jim Plunkett, to get things started. Pete McCloskey, a well-connected former U.S. representative, joined the bank's board to give it credibility with the venture capital community. But what went wrong? When it was founded in 1983, the banking industry didn't have a good understanding of startup companies, particularly those without revenue. Silicon Valley Bank structured its loans based on the understanding that startups do not earn revenue immediately, managing risk based on their business model. The bank connected customers to its extensive venture capital, law, and accounting firm network, and collected deposits from businesses financed through venture capital. Initially, startup founders seeking loans from the bank had to pledge about half of their shares as collateral, but the rate later fell to about 7%, reflecting a low failure rate and founders' tendency to pay off the loans to stay in control of the company. During the 1980s, Silicon Valley Bank grew with the local high-tech economy, achieving 21 consecutive quarters of profitability. It went from a loss of $39,000 in 1985 to a profit of $12.3 million in 1991. Under CEO Roger Smith's leadership, the bank diversified into the high-risk real estate loan business, which amounted to 50% of its portfolio by the early 1990s. A slump in the California real estate market resulted in a $2.2 million loss for the bank in 1992, and by 1995 the portfolio percentage had fallen to 10%. In 1993, John C. Dean was appointed CEO, with Smith becoming vice chairman. The bank added a winery lending business in 1994. Despite some early bumps in the road, Silicon Valley Bank seemed poised for continued success. During the dot-com bubble, Silicon Valley Bank found itself in the right place at the right time. As computer technology startups mushroomed, so did the bank's business. Unlike other banks that were hesitant to lend to unprofitable ventures, Silicon Valley Bank was more than willing to lend money to startups at the venture stage. Among the 2,000 clients the bank served in 1995 were networking giants Bay Networks and Cisco Systems. In that same year, the bank relocated its headquarters from San Jose to Santa Clara. The bank's stock price skyrocketed during the dot-com boom, but took a hit when the bubble burst, falling 50%. Despite this, Silicon Valley Bank continued to expand its branches to other technology hubs across the country. Ken Wilcox took the helm as CEO in 2000 and decided to maintain the bank's niche focus on technology companies instead of branching out to become a more general commercial bank. In 2002, Silicon Valley Bank formally entered the private banking business, capitalizing on prior experience and relationships with wealthy venture capitalists and entrepreneurs. By 2003, the bank had sponsored 3 high-profile international trade missions to Bangalore and Mumbai, Tel Aviv, and Shanghai and Beijing, bringing along a delegation of 24 Silicon Valley venture capitalists to meet with local investors, entrepreneurs, and government officials. This effort served as a prelude to opening international offices. In 2004, the bank announced an international expansion drive that included new operations in Bangalore, London, Beijing, and Israel. During the dot-com bubble, Silicon Valley Bank lent to venture-stage companies that were not yet profitable, which included notable clients such as Cisco Systems and Bay Networks. Ken Wilcox became CEO in 2000 and chose to continue the company's niche focus on technology companies. In 2002, SVB formally entered the private banking business, building on prior experience and relationships with wealthy venture capitalists and entrepreneurs. The bank announced an international expansion drive in 2004, with new operations in Bangalore, London, Beijing, and Israel. However, during the 2007 to 2008 financial crisis, SVB Financial Group received a $235 million investment from the federal government in exchange for preferred stock and warrants under the Troubled Asset Relief Program. It paid $10 million in dividends to the U.S. Treasury over 2 years, then used the proceeds of a $300 million stock sale to buy back the government's interest. In April 2011, Greg Becker replaced Wilcox as CEO. In 2012, SVB partnered with Shanghai Pudong Development Bank to create a separate Shanghai-based bank, SBD Silicon Valley Bank, to lend to local technology startups. The new bank, owned 50-50 by the two companies, received approval from Chinese bank regulators to operate in renminbi, making it one of a handful of American-owned banks permitted to do so. SVB also managed 2 local yuan-denominated funds for Shanghai's Yongpu District government and invested in a Hangzhou-based loan guarantee company. In 2015, SVB served 65% of all U.S. startups and offered syndicated loans and foreign currency management. It was also the only U.S. financial institution at the time working with virtual currency startups. SVB was the finance partner during the launch of Stripe's Atlas platform in February 2016 to help startups register as U.S. corporations. However, in June 2021, Mooney Agad, a former senior vice president and director at the bank, pleaded guilty to violating insider trading laws in 2015 and 2016 when he tipped off a friend about 3 startup acquisitions. Silicon Valley Bank involvement in financing acquisitions for startups gave it insider information regarding such acquisitions. SVB Financial Group primarily served businesses and individuals in the technology, life science, healthcare, private equity, venture capital, and premium wine industries. It gained a reputation for being unusually willing to serve C corporations in India whose founders lacked social security numbers. However, despite serving the high-tech sector, the bank faced criticism for its old technology and lack of biometric authentication. As of December 31, 2022, the bank's loan portfolio consisted of 56% loans to venture capital firms and private equity firms, secured by their limited partner commitments and used to make investments in private companies. 14% of the loans were mortgages to high-net-worth individuals, and 24% of the loans were to technology and healthcare companies, including 9% to early and growth-stage startup companies. To borrow from Silicon Valley Bank, clients were required to have an exclusive relationship with the bank. In February 2023, Forbes ranked SVB Financial Group as the #20 America's Best Banks, citing a 13.8% return on equity. In March 2023, Moody's Investors Service rated the bank's loan portfolio as conservative and high-performing. The bank's overseas subsidiaries held $13.9 billion in deposits. Silicon Valley Bank was a leading institution for businesses and individuals in the technology, life science, healthcare, private equity, venture capital, and premium wine industries. However, in 2022, the bank incurred significant losses due to increased interest rates and a downturn in the tech industry, which led to a bank run driven by tech industry investors. In March 2023, The California Department of Financial Protection and Innovation took possession of the bank due to inadequate liquidity and insolvency and appointed the FDIC as receiver. The FDIC established a Deposit Insurance National Bank, the Deposit Insurance National Bank of Santa Clara, to reopen the bank's branches the following Monday and enable access to insured deposits. The FDIC then transferred SVB assets to a new bridge bank, Silicon Valley Bridge Bank, NA, and appointed Tim May-Apollos as CEO. The new entity is an FDIC-operated bank, and all SVB clients will become customers of the new bridge bank. The failure of SVB was the largest of any bank since the 2007 to 2008 financial crisis by assets, and the second largest in US history behind that of Washington Mutual. However, the UK government announced that it was working on a lifeline for British tech firms affected by the collapse of the bank and its branch in the United Kingdom as part of the fallout from the parent bank. HSBC UK ultimately acquired Silicon Valley Bank UK for £1 in a rescue deal, with depositors fully protected. The failure of Silicon Valley Bank highlights the importance of risk management and maintaining adequate liquidity in the banking industry. While the FDIC was able to ensure that insured deposits were protected and transferred to a new bridge bank, many depositors with uninsured accounts faced significant losses. The aftermath of the collapse also highlights the role of social media in disseminating information about bank runs and influencing the actions of investors and regulators.